Alright, so here we are, class 21, and a whole new topic, one of my favorite topics. Today we're going to start on pricing of life insurance. I'll give you some background, introduce you to the mortality table, how to use the symbols. In this class it'll be a little unusual. I've been using PowerPoint to go through the class notes. In this one I'll do the introduction, some of the introduction in the class notes, but then you're going to find a lot of the pricing part of this class I'll be doing in Excel. And I'd recommend you, that what you do is you pull up the same mortality table file that I have, and I'll let you, you can put it on pause as you find that file, and I'll show you exactly what file that is. And I'm going to actually work the problems in that file, so I have access to the numbers. I don't have to go hunting for them. The pricing is a big chunk of the final exam. It's probably at least half of it. A lot of math. The math tends to be pretty straightforward with a couple of tricky questions. We're going to see one of the tricky questions today, and then probably the November 10th class we'll see the other tricky questions. So let's give a little bit of background on this. So we're up to page 60 on the note. When you're pricing insurance, the theory in perfect competition is your price equals marginal cost, and that includes the cost of capital. So that's the same for insurance. You want a competitive market. As we saw earlier when we talked about the ethics on the first exam, that we may not have a perfectly competitive environment because of the asymmetric information. But theoretically, firms need to make their cost of capital. So what will the market actually bear? The elasticity of the demand for life insurance. Life insurance is sold, it's not bought. I don't think people who buy life insurance and annuities are all that price sensitive because it's hard. Remember we talked about how hard it is to comparison shop. So it's a guilt type of purchase. People are shamed into buying it a lot of times. Take care of your family. You can't leave them without resources, those kind of things. There is competition, but it amazes me on the property casualty side, property casualty auto insurance especially, but also homeowners, their prices are very heavily regulated. There's a lot of regulatory input as far as you can't charge too much. You gotta, you gotta cut your prices. Some states like California have just gone in and told the industry they gotta cut prices across the board. And yet that's an industry where the prices are pretty competitive. Most people, you can compare auto insurance between two firms. It's not that difficult. There are a few bells and whistles, but it's pretty straightforward. And the prices tend to be fairly close together. You're not going to find one company that's just a whole lot more expensive than another, especially the big major players like the State Farms, Allstates, and Farmers, and UTSA, Geico's, Progressive. The life insurance industry is not that heavily price regulated, and yet their prices are all over the board. It's truly remarkable how different prices are on the life insurance side, and it's because you have those commissioned sales agents. When they're out there making the sell, most people are too embarrassed to say, well, can I see what your competitor is charging? It's just an uncomfortable conversation. And so it amazes me. The elasticity tends not to be there. The competition, again, because of the way they sell it, the competition is somewhat kept out of the room. So the sales agent is in the room with that person and they have control over the conversation. The buyer's ability to pay, that can definitely be an issue. But life insurance, term life insurance, is not that expensive. So it's really the more fancy, high-powered products that tend to be expensive, especially from a standpoint of what you're getting. So it's the same issue for insurance. Is there strong competition? For some reason, the industry, the regulators don't seem to be worried about this. On the life insurance side, they're very worried about on the auto and homeowners insurance side, on property casualty side. But the one exception is healthcare, obviously. We've had some rules and laws about healthcare and what they can charge, so that is becoming more regulated, and the Affordable Care Act put some requirements on that. We're not going to be pricing health insurance at all. It's a much more difficult product to price. But we'll definitely do life insurance, and I'll even give you some annuities. So the key is, with life insurance, has to do with the cost of goods sold. So insurance is very different. Most products, when you sell a product, your cost of goods sold up front. If you're selling Pepsi to HEB to sell in their stores, you know how much a bottle of Pepsi costs you. The to produce, and you know that before you send it over to HEB. So you know your cost of good in advance. With life insurance, you may not know your cost of goods sold for decades, especially if you're selling a whole life policy. So the pricing is based on forecasts and estimates specifically about when people are going to die, and you also have to be careful of healthy people staying in or dropping out, and unhealthy people staying in. That adverse selection on the life side, or healthy people buying annuities, unhealthy people not buying annuities. You have to adjust all that adverse selection into your pricing. So this uncertainty on cost of goods sold is a very unique nature of insurance. You could say the same thing on banking, because banking, when they make loans, they don't know how many loans are going to go bad. So it's a little different, but banks don't have the issue. Usually don't go out 20, 30, 40 years. Even their home mortgages, they tend to get those off the books and securitize them. So this creates a special type of risk, especially for life insurance. You don't see this as much on the auto homeowners inside on the property casualty side. Those are usually what we call short tail lines. They usually go 1 year, and then all the risk is over. So if the insurance didn't price it correctly, they can reprice it every year. Whereas life insurance, you sell a whole life policy, you're stuck with that premium until that person dies, and that can be 20, 30, 40, 50 years. Now, obviously, if they make it 50 years, you probably did well in the product. But you still can't change it. Just because you start seeing mortality rising, you can't go in and say, hey, we got to raise your premium, because it's a fixed premium for life. It creates great risk that must be incorporated into the pricing. Pricing is going to be based on the required return on capital, return on invested capital. That's got, it needs to equal or exceed their cost of capital. So they have the same requirement to have any other entity. Now, for most entities, when you use the word capital, you mean debt and equity. What I've seen with banks and insurance companies, the word capital almost always just means net worth. But let's go back to Miller-Modigliani. Hopefully you remember this. If not, I would definitely look it up before you interview for jobs. Most actuaries I've dealt with on the pricing side know Miller-Modigliani very well. So it must be covered on the exams. So Miller-Modigliani to say, okay, you need capital to run a business. Capital is on the liability side. It's debt and equity. I've had debates with accountants that think capital is on the asset side because they think of capital assets. But a capital asset is an asset that's purchased with the capital that you got from debt and equity. So capital is on the right-hand side of the balance sheet, not on the left-hand side. It's not an asset. So capital is the cash you need to run your operation. You can get that capital either from your debt holders or your equity holders. We're going to see with insurance, they don't usually borrow money. Instead, they get their cash from their policyholders. So insurance is almost a type of debt. Those that had my property and casualty class last semester or taking it next semester, we talk about that idea of insurance customers being really capital providers to the insurance industry. So Miller-Modigliani said, you want to combine debt and equity. So how much debt do you have? How much equity? Should you borrow money or should you issue equity? And they said the key is to minimize your cost of capital. Wherever you get the minimum cost of capital, that's where you have the maximum value of the firm. Debt is cheaper than equity, but as you increase the amount of debt, your cost of equity goes up. So again, hopefully you've had this. You can Wikipedia it if you're not remembering it. But yeah, you can't just add cheaper debt and say, hey, I want to do 99% debt and 1% equity, because your cost of equity is going to be so high. And in fact, what Miller-Modigliani discovered is before taxes and before bankruptcy costs, it doesn't matter how much debt and equity you have. The value of the firm stays exactly the same. Why? Because as you shift more in the cheaper debt, your cost of equity goes up and exactly offsets that, and your cost of capital doesn't change. In a world with debt and with bankruptcy, and a world with taxes, in a world with taxes and with bankruptcy cost, there is actually a difference between using debt and equity. So right now, interest on debt is tax deductible, whereas dividends to stockholders are not tax deductible. And because of that, debt gives you what's called a tax shield, the tax shield of debt. And so that would imply, wow, let's use a lot of debt, because when we use debt, the U.S. taxpayer covers part of our cost of capital. Well, that's true up until a point, but at some point you have so much debt, your bankruptcy costs start taking over. Bankruptcy can be actually your cost of debt itself will start rising because the firm thinks, wow, if this firm goes under, they have so much debt, debt holders are going to be standing in line waiting for the few assets that are left over, versus if you have lower debt, the debt holders have a whole lot more collateral, a lot more assets. So as you increase your debt, your cost of debt goes up. So at some point, you use so much debt that the bankruptcy costs will overwhelm the tax shield. So there's some balance in between. So the theoretical optimal point is where you want to maximize the tax shield without going too far into bankruptcy. It's kind of the optimal point is the WACC, weighted average cost of capital, minimizing capital structure. Remember, weighted average cost of capital is your weighted debt times your cost of debt times 1 minus your tax rate, because it's tax deductible, plus the weight of equity times the cost of equity. Hopefully you had that in a couple of classes now. Just to show you graphically, this top line is the cost of equity. The y-axis is how much debt they have. So if you go from right here on the far left, they have no debt at all. It's all equity. And as you go right, you add more debt. And as you see, as you add more debt, their cost of equity goes up. Your cost of debt stays kind of flat, but it also goes up eventually. If you borrow too much money, your cost of debt. They don't have this perfectly drawn, because if you have 100% debt, your cost of debt should be the same as your cost of equity, because essentially, your bondholders are equity holders in that case. So they don't have it perfectly to scale. But the key here is the weighted average cost of capital, and understand why this line does this. So this is the cost of capital. And you notice as they add debt, cost of capital comes down. It's not coming down because the cost of debt is lower than the cost of equity, because these two offset. You notice as cost of debt, as you use more debt, the lower number, your cost of equity goes up, and it exactly offsets it. So the only reason this red line, your cost of capital, is coming down is because of the tax shield of debt. And in here, it starts going back up because of that bankruptcy cost, the risk of going under, and the inflexibility that gives you. So, so your optimal capital structure is where you minimize costs of capital. And that's that optimal point right here. There's several other graphs. You can actually type optimal capital structure and look at the images that come up, and you'll see it drawn different ways. Sometimes I've seen it drawn, well, here they have cost of capital and how much debt. I've also seen it as the value of the firm versus the amount of debt, where in that case, it kind of goes upside down. Value goes up at some point and then comes down. Here they're doing it as a cost of capital, so it's inverse. Important, very, very important theory of finance, no question. So insurance and banks are a little bit different. Capital is really your net worth. It doesn't include debt and equity. And your capital really has a unique function in that it's a cushion against risk, because banks and insurance companies do a lot of risky things, and they don't necessarily have a lot of assets, a lot of net worth relative to their assets. So you're using capital to avoid insolvency. A typical bank might have $10 in assets for $1 in net worth. So it's very, very skewed. Life insurance companies are very similar. $10 in assets for $1 in net worth. Property and casualty, not quite as skewed. They might be more like 4 to 1 because it's just a much riskier business. But life insurance companies are pretty financially leveraged. But they do need to make sure they have enough capital to cover any meaningful risk. So capital is only the equity, only the net worth, because their debt is really coming from their customers, coming from deposits, insurance reserves. So they're essentially borrowing money from their customers. So they only look at the cost of equity, don't look at the cost of debt and equity. But you can do Miller Modigliani's with a life insurance company. It's just you might be forced to borrow some money in order to get the optimal point, where you normally wouldn't borrow money at all, just to get the tax shield. The tax shield is very different with life insurance, because the life insurance industry is taxed in a very unique, unusual way. And because of that, they may not use very much debt at all. They may entirely rely on their policyholders to get the capital they need over and above their net worth. So here's the key. More risky companies need more net worth, more cushion in case they go to keep them from going under, and their required return is going to be higher. So their cost of capital will be higher because they're riskier. So if you think about it, more risky companies have a double hit on their return on capital. They need more capital, which increases how much earnings that they got to make, and they need a higher return because they're riskier. So insurance is a perfect example. We talked about this in my risk management class. Insurance is a perfect example to increase the value of the firm by managing risk better, because insurance is a direct feed through the returns the company needs for its stockholders. And we'll talk about that more when we look at risk-based capital and how that comes into the equation. You'll see it. I have an exercise that's pretty real life that you'll see how this works together. Not part of the pricing, but it's when we get to the ALM, asset liability management side. All right, so life insurance. Term insurance is the most risky because you don't have much capital. Think about your whole life. You've got the life insurance, but you also have the savings element. So you've got like this cushion built into the product. Term, you don't have that. All you have is the insurance. There's no cash value, so you got a much lower premium. So it's much riskier, so you need more net worth. Whole life is not quite as risky because you have the cash value. So essentially the insured is really helping you insure them. They're essentially insuring themselves. So it requires less net worth. Annuities are incredibly risky. We're going to see that. They require much more capital, mainly because of their sensitivity to interest rates. So life companies have asset liability departments. Asset liabilities, if you take assets minus liabilities, you get net worth, which is what we're calling capital. We're going to do an exercise on this. We'll certainly see it. I talk a lot about asset liability management or risk management class. It's one of my favorite topics. Now, so this is important to remember. Term is more risky. Term is more like auto insurance. It's very, year to year kind of thing. And even level term over 10 years, it's still very risky because you just don't have much capital that you're getting from your customer because your premiums are so low. Now, I saw a presentation we talked on exam 1 about Art Williams and Primerica. I saw a presentation from Primerica, and boy, was it deceptive. They showed their capital, their assets to capital, compared it to State Farm, and they said, look how much stronger we are. And it's totally bogus. Why? Because Primerica only sells term insurance. They should have a whole lot more capital versus their risk than State Farm, because State Farm sells annuities and whole life, a lot of whole life. Not only that, but they were actually showing a capital ratio that's developed by Standard & Poor's, and they didn't mention that Standard & Poor's rated State Farm much higher than Primerica. So they were saying, hey, our capital is better than State Farm, so we're a safe company, not realizing that, first of all, their capital really wasn't better when you adjust for the fact that they were just using, selling very, very risky term insurance, but also didn't reflect the fact that the very place they got their capital ratio from had rated the other company much higher than them. So, that's what we talk about, these sales force, when you're commission-based, boy, you have no control over what they're telling people, in their living room, so it's kind of shaky. All right, let's talk about the basic equation. So a premium for insurance. This is true for life and for property and casualty. You got to cover your claims. So life insurance, we're going to say cover your death benefits. For annuities, it's to cover those payouts over the life of the person. You got to cover your expenses on a present value basis, and then you have to have profit meet whatever your profit requirement is, so you get your cost of capital in there. The profit requirement is your required return on capital times your required capital. That term required capital, a little different than Miller-Mediolanti. Miller-Mediolanti is talking about your optimal level of capital. Life insurance and banking, we usually talk about how much capital you're required to hold because of regulations and credit ratings that you want. So required capital is net worth needed given the risk of the business, maybe related to the credit rating that they want. So whatever probability they think is acceptable, the probability of insolvency, that's the kind of capital they want to hold. And your regulators, your rating agencies, management, all of them can have their own opinion, but you probably have to manage to the lowest denominator. At UTSA, it was management that was much more conservative than everybody else. Rating agencies were second, and regulators were the easiest. But you have these competing requirements, and whatever your highest requirement is, that's what you've got to set aside. So the premium can be broken between the net premium and loading. So we talked about the gross premium. The gross premium is what you actually charge. The net premium is only the present value of death benefits. The net premium excludes the expenses and the profit. So we call it the net premium. Those that took my P&C class, we call it the pure premium. That's the premium that's just there just to cover the claims. It doesn't cover anything else, profit, expenses. The expenses and profit we refer to as loading. I don't know if on the property casualty side they use the term loading. So if you see this equation up here, here's the net premium, and here's the loading, present value of expenses and the profit requirement. So you're taking a present value, so you need a discount rate. We're going to use the investment discount rate, and I'll show you why that's the case here because we're only doing the net premium. So you need to line it up based on what you think your portfolio is going to earn, and then you'll add a little bit more profit requirement when you do the loading. We're only pricing the net premium, and you're going to see that keeps it fairly straightforward. All right, so here's where it gets a little tricky. Take notes. I'm going to jump from here back to the class notes when we do the examples because I don't want to copy all these examples in the PowerPoint. But take notes, learn these terms. I'm going to show you the mortality table so that you can see these numbers in action. But there's four symbols you really need. L sub x, D sub x, Q sub x, and P sub x. Now you already saw the Q sub x in Article 1 that you did for Paper 1. That was that probability of death. You can go back and look at that formula, but it actually used Q sub x because that's the term you use. So Q sub x is your probability of dying. So L sub x is the number of people living at the beginning of the year for each age group. X is your age. So L27 would be the number of people alive at the beginning of their 27th year, right after 27th birthday. So LX is at the beginning of year. DX you can tell DX is the number of people dying in the year they are age X. So D27 will be the number of people age 27 who die between their 27th birthday and their 28th birthday. Now we're going to assume in our pricing that LX is always at the beginning of year and DX is always at the end of the year. And in fact, the regulators do the same thing, and then they adjust. They have some adjustments to get you the right reserves and those kind of things. They're not necessarily being conservative to make you overstate everything, but yeah, LX is assumed beginning of the year. DX is assumed at the end of the year. You'll see why that's really important when we do the pricing problems, to make sure you have the N correct when you start doing present values. So QX and PX, QX is your probability of dying during year X. PX is your probability of living during year X. Or probably you'll be alive at X plus 1. QX equals 1 minus PX, and PX equals 1 minus QX. They have to add up, so these two have to add up to 100%. Then if you do NPX and QX, NPX is the probability that you will live until N more years. You will live N more years. If your age, let's say we do 20P30, 20P30 would be the probability someone alive today at age 30 will still be alive on their 50th birthday. So 30 years plus 20 years, so 20P30 would be someone alive at age 30, the probability they will make it, be alive, still alive at age 50. NQX is just the exact opposite of that. It's the probability a person X, age X today, will die within the next N years. So if we're doing 20QX, or I'm sorry, 20Q30, then if someone alive today at age 30, the probability they'll die sometime between now and their 50th birthday. We don't know exactly when, but just a probability of them dying anytime during that time. And obviously NPX and NQX have to equal 100%, just like QX and PX have to equal 100%. So the Q's and the P's are all probabilities. The LX and DX are actually number of people. So we can do a few other formulas, and this gets a little tricky. We'll get some practice on this. But Lx plus 1 equals Lx minus dx. Now what I recommend you do when you get these problems, some students really struggle with these problems. They can get a little complicated, but I would recommend you have the mortality table in front of you, and you'll see that, let's say X is 25. So you take the people alive at the beginning of age 25 minus the people who die during their 25th year. That's going to give you the number of people alive at age 26. So L26 equals L25 minus D25. All right, hopefully that makes sense. dx, by definition, equals Lx times Qx. Qx, your probability of dying. So you take the number of people alive at the beginning of the year times the probability of them dying. That gives you how many people will die. Or you can use algebra here, and dx divided by Lx, that's what Qx is. It's your probability of dying. Px, what you do with Px is you take the people alive at the next year divided by the people alive today, and that gives you that probability. So L26 divided by L25, obviously L26 would be lower than L25, and I think that's where some people get confused. Lx plus 1 looks like it might be bigger than Lx, but what we're saying is the number of people alive at age 26 versus divided by the number of people alive at age 25. Well, the difference in those two is D25, the number of people who died during their 25th year. And so, yeah, so P25 equals L26 divided by L25. It's the number of people who will make it one more year. So you can think of Px as really being 1 Px. You can do 1 Px is just Px, so the probability someone 25 makes it to 26, or probability someone who's 30 will make it to 31. And then NPX, this one's a little tricky, but you can get it, instead of doing x plus 1, you're really doing x plus n. So if x is 30 and n is 20, then NPX 20p30 is going to be L50 divided by L30. And that's going to give you the probability of someone who's 30 years old today that they'll still be alive at their 50th birthday. Now, they could die 3 seconds later, but all we're asking, are they still alive on the day they have their 50th birthday? Now, NQX is a little trickier. We have to take the people alive at age 26, or let's do our 20Q30. So we do people alive at age 30 minus people alive at age 50. Obviously, L30 is greater than L50. People alive because people have died, so you take that and divide it by LX. Or you could just say NQX is just 1 minus NPX. So these two add up, those two add up. All right, so those are our symbols. Now, what are we going to do with all of these symbols? And that's where we're going to go next and get some practice with how to use these symbols. So here's the mortality table. You should have this file opened. It's out there on Blackboard, and you definitely want to have it open as we work these problems. But let's just walk through it. So the first column is age. I might show you another mortality table. This one's a little bit different format than the more current ones. But this is age. The next column is number of people alive at the beginning of the year. P sub x is the probability, or the percentage that make it to the end of the year. dx is the number of people who die during the year. And Q sub x is the percentage that dies. So obviously P sub x and Q sub x equal 100%. I started the table at 100,000. They usually start with 1 million or so, but I brought it down to 100,000. Just makes the math a little easier to work. This is a table for men, non-smoking, but there's a table for men, for women, for smokers, non-smokers. There's ultimate tables and select tables, and we'll talk some of those things. You'll notice generally mortality increases as we age, with the one exception here. For men, mortality actually declines for a few years before coming back up, and that's mainly because of driving. Men are more likely to die in auto accidents because we're worse drivers, and because of that, our mortality actually comes down in our 20s because we're less likely to die in an automobile accident. It's still pretty low, and it's not that much of a difference, but that's the one place. For the rest of the table, our mortality increases, and obviously when we hit 99, everybody dies. We're assuming everybody dies that year before they make it to 100. So your mortality at the end is 100%. So we're going to use this table to make decisions. There's two types of problems that we're going to do. There are problems where you just have to work with the symbols and do some analysis and some simple calculations. I say simple, it's actually the worst part of the exam for most students. I think students get so lost in the symbols that they don't step back and ask what the question is, and I'll try to help you with that if we do some examples. The second type of problem is where I give you an actual problem and you come up with the premium, or you give me the formula for the premium. Most students do very, very well on that part. It's a lot more straightforward. All right, so there's our mortality table. All right, so if we look at the class notes, I'm on the class notes at the bottom of page 61. We're going to look at some examples, or somewhere around this. You can find it in your notes. So let's look at a few of those. Some of these will actually go to the table and try. But sometimes all I want you to do is tell me what the symbol means. So before you read the answer here, look at this. What is 6p45? So you know p means the probability of living. 45 is the age today. So anytime you see these, it's the age today. And then 6 is, well, it does not be age today, but the age. You're asking a question about this person. So someone who is 45 years old, whether it's today or 10 years from now, what's the probability that someone who is 45 years old today will live another 6 years? So it represents the probability that a person age 45 will live another 6 years or make it to age 51. They will be alive for their 51st birthday. 25, Q25, so again, Q is probably a death. We're talking about a 25-year-old. So it's the probability that someone who is 25 today, so the number on the right is your age that you're asking about. This one's a little tricky because they're both 25, but this 25 is 25 years. This is your age. So the probability that someone is 25 today will die sometime between now and his or her 50th birthday. And really it's his because it's a male table, not a female table. The next one is life expectancy. Now this is an important one. What does life expectancy mean? So the definition of life expectancy is you have a 50% chance of dying before that age. You have a 50% chance of living longer than that age. So how do we do life expectancy? Well, our 25-year-olds, we're starting on the table with 100,000 people. So what we're looking for is where on the table do we find L 50,000? Because, I mean, where is LX? Which age is the LX 50,000? So we're 100,000 today. We're going down until we find 50,000 people alive. You can see somewhere, it's not 50, it's not 75, because remember they have to die right at the end of the year. So it's somewhere between 75 and 76. Depends on how you count it. But if someone 25 years old today, they have a little bit higher than a 50% chance of making it to age 55. But sometime, I mean 75, sometime during their 75th year, they're going to die. We know they're going to die right at the end of the year. So on the exam, I'm okay with you saying 75 or 76. I think here 76 makes more sense, but the probability is not going to be exactly 50%. But you're just looking for that halfway point. Then I asked the question, who has a higher life expectancy? Life expectancy is an age. So it's not how many more years you're going to live, it's to what age. So who has a higher life expectancy, a 25-year-old or a 75-year-old? And the answer is a 75-year-old. Why? Because they've already made it to 75. So their probability of making it making it to 76, 77, 78, it's much higher. So we can look at this and we can just see for a 25-year-old, their life expectancy is somewhere around 75, 76, but for a 75-year-old, you take the 50,698 and divide by 2, you get 25,349, so somewhere around here. So 75-year-old is expected to make it past their 82nd birthday and die somewhere between their 83rd, and that's 50% of them will do that. So a 75-year-old is expected to live to a later age than a 25-year-old. Not live more years. The 75-year-old is only expected to live about 7 years. The 25-year-old is expected to live about 50 more years, but the life expectancy is the age they make it to, not the number of more years. All right, let's do a few more. What's the probability of someone who's 30 years old today living, so that sounds like a P, but I'm asking you only use Q's, 30 years old today living 10 more years? So we know the answer is 10p30. That's pretty straightforward, but if you can only use Q's, then it's 1 minus 10q30. You could always also write this as L40 over L30. So L40 divided by L30. This is the one I think that the students struggle with the most. So number of people alive at age 40 divided by the number of people alive at age 30. That's the probability that a 30-year-old will live another 10 years. I think a lot of students look at that and they go, wow, L40 should be on the bottom. But remember, L40 is a smaller number than L30 because, you know, L30 are 30-year-olds, L40 is 40 years old. Obviously, you can't have more people alive. People don't come back to life. So if you have a population starting with 100,000 and you have maybe 98,000 still alive at age 30, you'll have to have fewer alive still at age 40. All right, a little more practice there. The probability of a 40-year-old dying. So now we're talking about Q's, but I'm not going to let you use Q's. You're going to use L's. Now I just showed you that the P's are pretty easy. You just do the later L over the earlier L. So you know, with P's, they're asking about the probability of living. You would just do L50 over L40, right? So 40 plus 10 is 50, so L50 over L40. But here we're not asking for people living, we're asking for people dying. So then you're going to take 1 minus that. Another way of writing that, and you can see it's just algebraically the same, you can do L40 minus L50. Again, students struggle with that. Remember, L50 is a smaller number. L40 minus L50 divided by L40, that will give you the same answer. It's the same thing as 1 minus 10p40 is the same thing as 10q40, or like this. So on the exam, if I say you can only use L's, you could do it like that, or you could do it like that. Either one would be fine, and mathematically those are the same thing. So L30 plus D29 divided by L28. What in the world is that? All right, so this is another tough one. What is L30? People alive at age 30 plus the people who died at age 29. Well, if you think about that, that's L29. People alive at age 30 plus those who died during their 29th year, that's L29. Not L30, but L29. And you're taking L29 over L28, that's just going to be P28. The people alive at 28, that's going to die by the time they make it to, before, I mean, they're going to be still alive at L28. L30 plus D29 is L29, so that equals P28. Now, what does the following here mean? So how complicated can I get? So L48 minus L50. So that's what? D48 and D49, right? L48 minus L50 is D48, D45. It's not D50. It's not D50 because D50, you're talking L50 means people alive at their 50th birthday. So you don't have D50 in there. But if we add D50 here, now we got D48, D49, D50. Here we got D51 through 57. You don't include 58 because they're still alive. So you go all the way to D57. So we're looking at people dying, people who are 48 today, what's the probability of them dying before their 58th birthday? So we could say the probability of their living is L58 over L48, but if we take 1 minus that, then you get the equation. So really the answer here is 1 minus 1048. There's 10 of them here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 1 minus 10p48. So just getting you some practice. When you take an L, let's take L45 minus L50, then that means the D45, 46, 47, 48, 49 is 5 years, but you do not include the D50. This will be important when we do some the more complicated pricing problems a little bit later. All right. This one, I don't like this question. I used to do this on the exam. I really don't like this, though. But first of all, we got Mary and her husband, so we can't use this table for Mary, but we can use the symbols. So Mary's 35. Her husband is 33. Actually, I thought this was a life expectancy one, so somewhere in here I have a life expectancy. This one's not. This one's actually an okay question. You'll see we'll be using this when we do joint life. So Mary's 35, her husband's 33. What's the probability they are both dead by the end of the year Mary's current? Well, that is life expectancy, so sorry about that. So what is Mary's life expectancy? So it's 76, so let's look at it, L35. So L35 is 98,227, so we take 98,227 and divide by 2, so we're looking for 49,113. And there it is. There's that. I'm going to use the later year, like it said, 76. So 35 to 76, that's 41 years. So the probability of Mary dying in the next 41 years is 41Q35. The reason I don't like this is some students got confused of whether or not the husband also makes it to his life expectancy, but that wasn't what I was saying. Is Mary's life expectancy is in 41 years, so you're doing them both at 41. So the probability of the husband dying next 41 years is 41Q33. And you can actually calculate the number. It's 2348. Now here you got to be really, really careful. You cannot say 41P35 times 41P33 does not 1 minus 41P35 times 41P33. Those are not the same thing. So here we'll practice this a little bit, but there's 4 scenarios here. You got Mary lives. That's 41P35. You can have husband lives. That's 41P33. You have Mary dies. That's 1 minus 41P35 or 41Q35. And husband dies. That's 1 minus 41P33. So we have 4 scenarios here. We have a scenario where they both live. If they both live, then that's going to be 41P35 times 41P33. They both die. That's the one we just did. That's going to be 41Q35 times 41Q33. But you can't have Mary lives and husband dies. So that's certainly a possibility. In that case, Mary lives is 41P35 times, I'm going to do it as a minus, 1 minus P41P33. So there's one scenario, Mary lives and the husband dies, or you can have Mary dies and husband lives. That's all the scenarios we have. So then we have 1 minus 41p35. I don't know why I can't spell the word lives for some reason. Times 41p33. These four things must add up to 100%. Some students get confused and they think this has to add up to 100%, that both live and both die, but that's not true. I mean, there's two other options. So if we added all these up, we get 100%. Now, the probability of them both dying is 23%. And so you'll see, you can calculate the others. We'll get some practice on this. We're going to use this type of math when we do the joint life, so you'll see how we do the joint life. All right. Now, sometimes on the exam, I actually ask you for the amount, the percentage, the probability, or the number, or whatever I'm asking for. Sometimes all I ask you on the exam is just to give me the symbols. Usually in the first part of the exam where I'm doing the symbols, I typically just ask for the symbols. Every once in a while I ask for you do the actual calculation. What's the probability that individuals 25 today will still be alive at age 70? Here's where you can get confused. Is it 70 minus 25? Or is it 70 minus 25 plus 1? Is it 70 minus 25 minus 1? And it's real simple. You just subtract them. You don't have to make any adjustment. We'll get into that. Since they're both at the end of the year, we'll get into that when we do the more complicated problem. You'll see how you have to do the math. But so 70 minus 25 is 45. So probability of an individual who's 25 today will just be 45p25 or L70 over L25. So here's the joint probability. Both die, both live. First dies, second lives. First lives, second dies. That has to add up to 100%. I don't have my... You might change the bullets here. So this one should be a unique question. So using L's and D's only, write the equation which would provide the probability of the following. Probability that two individuals, one who's 50 today, another 60 today, will both be dead in 10 years. So that's 10Q50 times 10Q60. But I said, if I said, using only L's and D's, then we know LQ50 is L50 minus L60 over L50. And I'm sorry, 10Q50 and 10Q60 is L60 minus L70 over L60. So only using L's, that's what you do. Doing D's would be really hard. To do D's, you'd have to do D50 plus D51 plus D52 all the way up through D59. And then you have to do D60, D61, C60. You just get to be far too complex. All right, so that's the probability of both dying. That's real similar to the formula we're going to use when we do the joint life. You'll see. Using P's and Q's only, write the equation which provide the probability that a woman who is 85 years old and her husband is 50 will both live another 5 years. That's actually pretty straightforward. 5p85 and 5p50. If you did it with L's, you remember when you're doing living, you just do L90 over L85. If you're talking about people dying, you do L85 minus L90 over L85 and L50 minus L55 over L50. That's how you get people dying, but people living, you just do L90 over L85. So these will give you the same answer. You should go to the mortality table and actually try it out. Why do I say assume independence? And that's something, when people are married, they're in cars together, they fly together, they do things together. And since they do things together, there's some joint probability. There's some probability they'll both die. I've been meaning to ask an actuary how they adjust for that in their analysis. They must do it some way, that there's a slightly higher probability both will die if they're married to each other. But here I'm assuming they're independent. Maybe they're married to each other, but they live on different coasts. One lives in California, one lives in Florida. So there's no joint probability. They're just completely independent. And that way this math works. I doubt the adjustment would be much. It's rare that you hear two people dying together in a, in a fire or in an auto accident. I mean, it happens, but pretty rarely that both died at the same time. What's the probability that an individual who's 45 today will live to be 60? So again, you just take 60 minus 45. You don't have to make any other adjustment. So just 15 P45 or 60 over L60 over L45. Probably a dying, you just take 1 minus that. Use the Q, 15Q45, or 1 minus the L formula. So when you just have one person, there's choices are living or dying, so that's when you can take 1 minus the other. And then again, you take L45 minus L60. You notice that the lower age goes first, always. L45 minus L60 over L45. What's the probability that at least one but not both individuals? So this is a really tricky one. At least one but not both, one who's 40, one who's 45 will be dead. So we're asking one or both. Now this gets a little tricky. There's a couple ways you can think about this. One is we can say, okay, well, we're talking about everything but these, we're talking about the two scenarios except for these two scenarios. They both live, that would not fit here. They both died, that doesn't fit here. We're looking for one but not both. So you could take 1 minus the sum of these two. So R, you can take 1 lives times 1 dies, right? And 1 dies times 1 lives. You can take these two, so 25P40 times 25Q45. That's the probability that the first one lives and the second one dies. Here's the first one dies, the second one lives. You just multiply, you add them. It's additive, so these add up to 100%, but you multiply to get the probability for the first one living, the second one dying, plus a probability of the first one dying, the second one living. You can do it all with P's by doing the 1 minus the P to do the death side. So however you write it, there's more than one way to write it. Here's a little bit of a tricky one. The mortality rate at age X can be best shown. Now we know that's Q sub X. We also know that's D sub X over L sub X. But let's look at that. dx plus 1 over Lx. Well, that makes no sense. People dying in their 26th year divided by people alive at their 25th year, that's a nonsensical number. People alive at 26 divided by people alive at 25, that's going to give you a probability of living. That's not your mortality rate, that's the probability of living. So your answer is 1 minus that. dx minus dx plus 1 will never, I can't think of any scenario where you want to subtract d's. You can add d's, but you never subtract d's. So this makes no sense. Now if they'd done L25 minus L26 over L25, that would have worked. But they didn't do that. They subtracted the d's. So here you do L25 minus L26 divided by L25. I hope I said that down here. L25 minus L26 over L25, which is the same thing of dx over Lx. So this is the right answer here. What is the probability a man aged 25 will die either at his 70th year or his 80th year? Now one thing to be careful of, if you take D25 over DL26 plus D26 over L26 plus D70 over L70 plus D80 over L80, that does not add up to 100%. And we know that because we know D99 over L99 is by itself 100%. So to get the 100%, you have to do D25 over L25 plus D26 over L25 plus D70 over L25. That would add up to 100%. So if you keep it as L25, you get the right answer. That's why this one's not correct. We're saying the man's 25 today. And this is a nonsensical question. We're just asking, you know, we don't care if he dies at age 71 or 68 or 69 or 77 or 81. We just want to know his probability he's going to die either at age during his 7th year or his 80th year. So you take D70 over L25 plus D80 over L25. And that, if you do that, all those together, you get 100%. So then you just ask, what's the probability of either one of those 2 years, and that will give you that probability. One last kind of crazy one. The probability someone age 32 will live to be age 34. Now we know that's 2p32, but looking at these two, L32 minus L34, it's in the right order, but that's the probability of them dying. That's the Q2Q32. L33 plus D34, that doesn't make sense to us. That doesn't make sense at all. You would never add back L33 plus D34 or L33 plus D33. What you're looking for is L33 plus D32. So that would make the most sense, but that's not what they have here. Have D34. That's nonsense. D32 plus D33, well, that's the probability someone will die in the next 2 years. That one's a good answer. In fact, that's essentially the exact same as this first one. This one, that is the exact same. L32 minus L34 is the same thing as D32 plus D33. So that's exactly the same. So let's look at this one. L35 plus L34. What is that? That's L33. So you take the people alive at the first year plus the previous year deaths, and that will give you the L of the previous year. So this is the same thing as L34 over L32, and that's the same thing as 2p32. All right, so there's our formulas. This is something you might understand it now, but it's a little shaky. I think the key is that you really know these formulas here at the bottom of page 61. I'm going to delete what I added here so my page numbers don't get off. But you can go back to the video and look at that. So it takes a little bit of practice. But if you step back and actually, that's why I say go look at the mortality table while you're doing these, and that should make it pretty obvious to you. Your probably best bet on a question like this is kind of nonsensical is write it as a P, write it with L's, and then try to figure out which one of these represent that. All right, so what we're going to do is we're going to price the net premium. And so that's for life insurance, it's going to be a death benefit divided by 1 plus a discount rate raised to time. We'll be using this formula over and over again. The only adjustment we have to make is how many people are there alive to pay the premiums, and we'll see that. So the numerator is your cash outflow. It's usually a D, it can be an L. We're doing annuities, and we multiply that by the face. The denominator is the number of premium payers. We have to adjust both of these for time value of money. And there's one real key right now that makes you really, really comfortable with. The numerator on deaths, we assume all deaths happen at the end of the year. On premiums, we assume all premiums are paid at the beginning of the year. And so your D's in the numerator will usually be 1 year off from your L's in the denominator. You'll see that when we get into these problems, that'll make more sense. Now, if we're doing annuities, we assume annuities pay at the beginning of the year because we're paying them the L's. So anytime you're doing an L, whether it's numerator or the denominator, you're talking about the beginning of the year. Anytime you do a D, you're talking about the end of the year. So what we're going to do from here, I'm going to stop the class here, let you kind of let this sink in. Be ready in Excel. We'll use more Excel next time. We're going to work through several problems. And I'm going to do them in Excel. I'll write them in Excel so you can actually see the problem, how you need to write it out on exam. I do this in the notes here. So we'll start right here in our next class. And just be ready. I think what you're going to find is this part of the class on pricing is a lot easier than what we did up here. Fortunately, this isn't a big part of the exam. You know, it's maybe 10% of the exam. So if you only get half of it right, it won't kill you. And most students do pretty well on this section of the exam. So we'll stop it there and we'll work through these problems and get you comfortable. What you're going to discover, I think, real quickly is once we do 2 or 3 problems, we just keep doing the same thing over and over again. It's just how many D's do we need, how many L's do we need, and what are the N's. And once we do that, we've got it going.